Your phone just vibrated. The market's bleeding. What did you just lose? Nothing. Yet. But you're about to. Not to the market. To yourself. Right now, the S&P is down 1.1%. NASDAQ down 1.47%. SoFi cratered 9%. Lemonade down 22%. And somewhere, someone just panic sold at the bottom of a normal Tuesday correction. That someone might be you. Not today, maybe, but soon. Because the most dangerous thing in your portfolio isn't volatility. It's the story you tell yourself when volatility arrives. Here's what's actually happening in your brain right now. You see red numbers. Your amygdala fires. 2,000 years of survival wiring screams. Danger. Your ancestors who ignored threats didn't survive long enough to become your ancestors. So you're hardwired to act, to do something, anything. Check your phone. Refresh your portfolio. Sell before it gets worse. This isn't weakness. It's biology, and it's bankrupting you. Seneca wrote this in the year 63. We suffer more often in imagination than in reality. He wasn't talking about markets, but he might as well have been, because the actual loss today, 1%, is statistical noise. It's a rounding error in a 20-year plan. But the imagined loss, the story you're telling yourself about what comes next, that's catastrophic. You're not responding to what happened. You're responding to the horror film your mind is producing about what might happen. And that film costs you real money. The average investor underperforms the S&P 500 by nearly 4% annually. Not because they pick bad stocks, because they buy high when the story feels good and sell low when the story feels bad. The market dropped 1% today. The story in your head says it might drop 10. So you sell. Then it recovers. So you buy back in higher. You just paid a premium for the privilege of feeling like you did something. This is the tax on being human. And it's far more expensive than capital gains. You think the problem is unpredictable markets. Seneca knew the problem is the predictable investor, the one who reacts the same way, every time, to the same stimulus. Down days trigger fear. Fear triggers checking. Checking triggers selling. Selling triggers regret. Regret triggers buying. The market isn't playing you. You're playing yourself. Let me show you what this looks like in real time. Marcus Stone and Alex Rivera are sitting in Marcus's study when the notification comes through. Alex's smartwatch lights up. 3 alerts in 10 seconds. Market down. Portfolio red. Breaking news. Alex doesn't even realize he's already reaching for his phone. Marcus doesn't move. He's reading. Physical book. Not a screen in sight. The contrast is almost absurd. Alex pulls up his portfolio. SoFi, down 9%. He bought it 3 weeks ago after it popped 15%. Felt smart. Momentum. Growth. Now it's red. Not just red, bleeding. He can feel his heart rate climbing. The watch confirms it. 85 beats per minute. 90. He looks at Marcus. Marcus is still reading. You see in this? Alex asks. Marcus doesn't look up. Seeing what? The market. Everything's tanking. Now Marcus looks up. Not at a screen. At Alex. How much are you down? SoFi's down 9% today. I'm red overall. How much? In dollars. Alex hesitates. Does the math. About 400. And your time horizon when you bought SoFi was what? 5 years. So you have 4 years and 11 months left. And you're checking it on day 21 because it's down $400. Does that sound like a 5-year investment or a 21-day bet? Alex doesn't answer because he knows the answer. Marcus continues. Seneca said we suffer more in imagination than reality. You haven't lost $400. Your unrealized position is down $400. If SoFi goes to zero, which it won't, you lose your initial investment. If it recovers, which statistically it likely will over 5 years, You lose nothing. But right now, you're paying a different price. The price of checking. You just spent 60 seconds feeling sick. You'll check again in an hour. Feel sick again. You'll check tonight before bed. Tomorrow morning. 20 times this week. That's 20 separate exposures to cortisol and adrenaline over something that hasn't actually happened. You're charging yourself an emotional tax for information that doesn't change your action. Because you're not selling, are you? Alex shakes his head. No. I wasn't planning to. We're planning to. Past tense. Which means you're considering it now. Why? What changed? It's down 9%. It was up 15% 3 weeks ago. Did you sell then? No. Why not? Because I thought it would keep going up. Marcus leans forward. This is the moment. So when it goes up, you hold because you think it will go higher. When it goes down, you want to sell because you think it will go lower. You are systematically engineering a strategy to sell low and buy high. And you think the market is the problem. The silence is heavy because Alex recognizes himself. And if you're honest, you recognize yourself too. Marcus continues. Quieter now. The Stoic investor doesn't ignore the market. He ignores his reaction to the market. The market dropped today. That's a fact. What that fact means is the story. And you get to choose the story. Is today's drop the beginning of a collapse? Or is it statistical noise in a long-term trend? You don't know. I don't know. Seneca didn't know. But the investor who needs to know, who needs certainty before he can be calm, will check obsessively, trade reactively, and underperform consistently. The investor who can sit with uncertainty, who can watch the fear arrive and not obey it, keeps his money and compounds it. Alex looks at his watch. Heart rate back to 70. He didn't do anything. The fear passed. It always does. What if it keeps dropping? Alex asks. Marcus smiles. Not mockingly, warmly. Then you'll have another opportunity to practice not checking. Here's your one action. The next time the market drops and you feel the pull, to check your portfolio, set a timer for 60 seconds. Sit with the discomfort. Don't open the app. Don't refresh the page. Just breathe. Feel the urge. Name it. That's fear. That's ancient wiring. That's biology trying to protect you from saber-toothed tigers by selling SoFi. After 60 seconds, the intensity will drop. Not to zero, but enough. Enough that you remember you're a long-term as an investor, not a hostage to your amygdala. Do this once. Then twice. Then 10 times. You're not building discipline. You're building evidence. Evidence that you can feel fear and not obey it. That's the skill. That's the edge. Most investors already know this is happening. Do you?